with that increase in the speed limit, people are showing a bit of a willingness to take up that higher LVR debt.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 2nd of March 2026. I'm Head of Research Nick Goodall, and today I'm joined as per usual by our Chief Economist Kelvin Davidson. Kelvin, let's get straight into it this morning. The lending data for January from the Reserve Bank returned some level of normality, I guess you'd say, after a pretty crazy December data. Do you want to take us all through all those data, please, mate?
Yeah, so some kind of return to normality. I mean, obviously the December numbers were just sort of off the charts in terms of craziness with all that bank switching going on, or refi as it's called in the industry. So yeah, it all came back off that massive peak in January, which was as expected, and we've already seen that the sales volumes numbers tail off, so you'd anticipate the same thing to come through in the lending data. So we definitely saw that. About 14 billion of lending in December, as I say, driven by that bank switching, came back to about 6 billion in January, which there's going to be a seasonality thing in there as well, with January always being quieter. So it was always likely to fall. But when you compare January back to January 2025, it was still up about $1 billion or 900 million. So, not bad in its own right. It just looks quite soft on a chart when you're comparing it back to that crazy December spike. So, it wasn't a bad month, but quieter than December. All the loan types pretty much settled back. House purchase activity was down a little bit year on year, down around 5% in dollar terms. So, yep, that was kind of expected too, because it did look like there was a bit of sort of a pull forward of activity into December. Maybe people were trying to lock in some cashbacks there as well. So, that house purchase activity for January was a little bit softer, not too bad, but kind of had the expected fall. Switching was actually still, pretty strong compared to anything other than December. Going back to November or prior, there was still a bit of activity there. And I'd been in at the banks a couple of times over the past few weeks, and they did expect, I suppose, just a little bit of a tail end of that switching activity. There was always going to be, I guess, a bit of a lag there with some loans to actually get them drawn down. So that was always going to be likely, but so there's still a bit of switching going on, not as much in December, but still a bit of activity there. The different breakdowns, interest-only lending was kind of ticking along, high DTI lending sort of ticking along. There's nothing sort of much of note in there. The thing that really jumped out of the different breakdowns was the LVR figures, which we've had an eye on. Obviously, given the LVRs were loosened on the 1st of December, always going to be some interest in those numbers in the December and January figures. And so there's a bit of interest in there. We saw the share of lending going out to investors at low deposit, or less than 30% deposit in this case, ticked up to about 3%. So only a couple of months ago that had been less than 1%. Now, still not sort of off the charts, but that's the highest number it's been for a number of years. So with that increase in the speed limit and on the 1st of December, just simply more low deposit finance available for investors. And also, I guess with interest rates where they are, some investors definitely keen to take up that finance. So it's ticking up a bit for investors, but also owner occupiers as well. About 15% of lending to them went out at low deposit, and less than 20% for owner occupiers. Now that's the highest it's been I think about since August 2020. So it's just interesting to see it playing out. You increase those LVR speed limits, people are showing a bit of appetite to take that debt out. In particular, first home buyers, we had a record share of first home buyers taking out low deposit loans. 57% of those first home buyer loans were done at less than 20% equity. So that's still a strong way in for first home buyers, as you don't need 20%. People are getting in with 15%, maybe 10%, I've heard. So, that's still a strong way in for first home buyers. And then just one final cut of the numbers is that we, on Friday, late Friday, we got the stock figures, I guess you'd call it. And so we are seeing that share of debt going out longer on those longer term fixed rates, to the point where about of all existing debt right now, it's about 30% that's currently fixed and not due to reprice for at least another 12 months. That's the highest it's been for a couple of years. So people, it's not sort of full on yet, but we are seeing that shift as I guess we reach the bottom of the rate curve. people starting to think about higher rates at some point. People starting to fix in longer, and we're seeing that come through both in those monthly flow numbers, but also the stock figures too. So, yeah, people positioning themselves for, I guess, an interest rate, a rising rate environment at some stage, looking to fix for a little bit longer. So, yeah, keeping an eye on those LVRs. Obviously, as the year goes by, we'll be watching DTIs too. But right now, yes, with that increase in the speed limit, people are showing a bit of a willingness to take up that higher LVR debt.
Yeah, I think that's the thing for me, right? That was the big question we had when these limits were announced to be extended, to be increased. We were like, yeah, it's all well and good to increase that potential lending, but will people be actually willing to take that on? Well, the banks would probably be willing to let it out. Like they're going to try and continue to increase their book at almost, any way possible. But just weren't sure how much, maybe not nervousness, but consciousness that those borrowers might have and go, well, there's plenty of stories out there about people who bought at peak and values have fallen, and so they're sitting in negative equity, or they're certainly sitting at, in a property with less than it was paid for, and so that's reduced their equity as opposed to, holding flat or increasing is obviously the dream for those people. Just how much that consciousness would play on people going, do I really want to extend as far as I can go? Do you really push beyond your means? Do you, maybe not beyond your means, but as far as you can go in terms of how much the bank will lend you? And I think, while this still might not be going to quite that extreme, it does show that there's the willingness and the ability there for people to just grow a little bit further, to say, yes, I know I can get a property without that big deposit or biggish deposit for a first home buyer. And I'm willing to do that because, I've got that long-term view. There is no expectation of values to fall away. Yes, okay, we're not expecting strong growth to come and increase your equity over time. But if you're on paying down your principal, values are going to hold flat at the very worst, which is what we expect to happen. Then I think the settings are there, I suppose, for those people to go. Going into low deposit, high LVR lending isn't necessarily a problem or a concern. You might pay a little bit extra for that, of course. There's often a little bit of an extra fee on those. But again, if that gets you into a house sooner rather than later, you are exiting in an expensive rental market, then I think it still stacks up for those first home buyers. And, that number you referenced, the 57% of all first home buyers getting into the market with less than that 20% deposit, I think we can never overplay how important that is, how much we need to continue to talk about that. The amount of times, as you said, we talk to bankers, we talk to brokers, and they're always surprised by the amount of first home buyers that come out of the woodwork and go, I heard there's a change to the deposit requirement. Can I buy a property now? And the broker would always say, you could have 6 months, a year ago, because you can be outside the limits. There is a speed limit here to allow first home buyers to do it. And quite clearly, in this case, the majority of them are doing so without that 20% deposit. So of course you want to get as much as you can for the bank's, reasoning, for your own consciousness, but you don't have to have that. And so ensuring that that's not seen as a barrier, but a preference maybe. I think that's a really important one that we continue to speak about as well. So, I think that's really good. Investors, same thing, right? Like you said, that 3% is so low, it feels like it's hardly worth talking about. But again, our question was, will investors, given the changing environment and not much growth on the capital expectation side of things, still high costs of holding properties. We know they're still doing mortgage top-ups. How many of them are willing to go, I'm going to increase the size of that debt compared to my equity, and which means you're still going to have a pretty decent-sized debt, which means you're probably going to be paying some, relatively high payments at a time when you're not expecting that capital growth to come through. And will investors really be willing to take on that level of debt compared to their equity? And this is showing that, there's some willingness out there. Yes, it's only going from, less than 1%, close to 0% to 3%. Now that they can, and we know that the bank's self-imposed limit is probably about 5%, given the actual limit is 10%. They like to keep that buffer. 3%, it's some way to that 5%. So the willingness, the ability is there, and it's going to continue to, I suppose, provide some tailwinds. The fact that this market has got the money is available and the borrowers out there willing to take it on just shows that there are these reasons to expect this demand to continue to grow through this year. And to the point now where we're going to go, at what point do we see the LVRs also become somewhat of a headwind the LVR restrictions a headwind to this market because, they could grow further, the market could grow further, demand could grow further until these limits kick in, and the banks are getting close to 20% for their owner-occupier limits and 5% for their investor limits. Maybe that's going to be something that just constrains what this growth phase could have otherwise looked like had they not been in place. And that's on top of the DTIs, which, as we've noted over the last few months, they're starting to increase as well. Yes, you've got to be careful with the data you're using because it's not quite as bad as the original data looks like. But definitely when we look at long-term expectations here, debt restrictions will come into play at some stage in the future and just limit what the growth phase looks like, which I think is an important, final position to, I suppose, stand on when we're looking at the lending data and what it means and how it's going to play out over the next 6 months, a year, and into next year as well. So yeah, I think it's an important data release, and like you said, also looking at that stock data, telling us how long people have got to go on their mortgages as well, because I think that's a big part of the flow through to how much money people might have in their back pocket and flowing that to the economy as well. So I think it's an interesting one to see those people push a bit longer, less people on those shorter terms, less people due to roll over in the next 6 months. And that means that, we're certainly in that phase of things turning out the other direction. So, always an intriguing one and great detail there. And I'm sure that'll continue to fill plenty of space in our, articles and presentations and things over the next few months and things as well. So, a really good one to cover off. Anything else triggered in your mind there you want to cover off? Otherwise, we can sort of chat about the big Cotality data report released last week.
Yeah, actually, just on the stock numbers, you also get a cut of the figures by sort of non-performing loans,
Great.
sort of how much bad debt the banks are allowing for. Those figures still sort of under control, if you want to call it that. Not great if you're behind on your loan for those individuals, not ideal. But in a wider, I guess, financial stability sense, there's still no real issues there. Non-performing loan ratios still pretty low, and over time the banks have been just slowly creeping down the amount of money, I guess, they're holding for potential bad debts. The sort of reserves, I guess, they're holding back. Those numbers are coming down too. So there's, again, it's something that it's been sitting in the background in this cycle. There just hasn't been much concern about bad debts, non-performing loans, mortgagee sales. All those things are still pretty low. So we'll keep watching it, but right now there's kind of no news there, I guess.
Yeah, absolutely. I think it's been one that we've always sort of waited and watched to see some significant change with, and it's never really come, right? Particularly in the last 2 or 3 years, as property values have gone sideways. I think it just illustrates that, yes, while the market's not going well and people aren't feeling great and they're not out there spending money, they are prioritising their mortgage, and so they're still managing to make that work. Even if the value's gone down, your mortgage doesn't go up in value. Yes, the LVR might increase, but ultimately you do whatever you can to pay your mortgage off. And even though we've seen, unemployment rise, it hasn't been super bad. I don't want to underplay it either, but again, it's been like lots of vacancies that haven't been employed, and we've seen obviously growth and demand for jobs as well. But actually the amount of people losing their jobs, which then means they can't afford to pay their mortgage and they're desperate to sell, and mortgagee sales and all these things, like there really hasn't been that significant pain. Again, I don't want to underplay. I know it's been tough out there for plenty of people as well. And there'll be some people that, haven't done it easy. But like I say, from those measures of, tracking, people missing payments and mortgagee sales and things, we just haven't seen the same holding out of the market as we have, say, in the global financial crisis when, mortgagee sales were way higher and non-performing loans were way higher and job losses were much greater as well. So, I just think, while it's hard to say it hasn't been that bad when you see the decline in property values across some parts, especially, Wellington down 25% still. And you sit there and go, how can people handle that? Well, again, if you're still in the house and your mortgage still, you can still get your job and you can pay that, and interest rate payments have come down, then you will find a way to survive and prioritise the mortgage, and that certainly seems to have been the case. So, I think that's just another backup of that, and one that we continue to watch for to see, where might pockets of trouble come up, and they just haven't really done so to any significant degree anyway. So another really good one to point out. But good one, Kelvin. I'll move on though. Let's look at the release last week. Of course, we did put out the Women in Property report last week. This is sort of an advance of International Women's Day every year, which is this coming Sunday, 8th of March, International Women's Day. And so we put out the report in advance of that, just looking at some of the differences across the genders in terms of property ownership, some of the implications of that, of course, and have conversations in market about, how we can ensure that we're having the better, conversations, and that maybe policy can start to change and we can start to see companies change these things. We also included some further breakdown breakdowns by generation this time around too, which provided some pretty stark differences there. Also, a little bit of a sustainability angle for what owners were doing to improve the sustainability of their homes, which was interesting at the same time. Again, you put together the report here, fronted the media, Kelvin. Do you want to run us through any of those key themes that you were talking about that really pervade throughout that report itself? And I know we had some, we had the same thing in Australia too. So maybe any, I don't know, top of the mind comparisons to Australia. But yeah, how'd that release go? And any big thoughts on the themes there, mate?
Yeah, no, it was good. Yeah, plenty of media interest, and it always it's one of those things we're only doing once a year, so people are always have their ears perked up by this release. Yeah, it's fronted both in Australia and here by two bald, bearded males talking about women and property. So that's always a bit of a backstory to it. But no, the report itself was really good. It's based on a survey, so it's a wee bit different, I guess, than what we're typically doing. We're using our own proprietary data, and it's pretty hard evidence most of the time. This is, I guess, not softer necessarily, but it's survey stuff. You've always got to keep that in mind. But what it showed was that there's definitely no lack of interest in property from females across the country, and in fact, more females rate property ownership as important or highly important than males do. So there's definitely a strong interest there in owning property. Just that when you come to the ownership stats, they are lower for females, and particularly when you get into those younger generations. I mean, across both genders, the ownership rates are lower the younger you are. Of course, there's no sort of rocket science there. But when you're comparing the Gen Z and millennial females to Gen Z and millennial males, the ownership rates are lower for females. So it's not an attitude thing, but there is a lower ownership rate. So then you start to look for why. And really, financial resources are going to be a big part of it. We know, unfortunately, there's a gender wage gap still, about minus 5% here for females earning 5% less for similar jobs. So that's going to be part of it. Now, that gender wage gap has closed, but still at 5%, so there's still sort of work to do there. And the survey evidence points to just lower earnings as well. There's relatively fewer females earning higher wages. I mean, an arbitrary sort of cutoff, let's call it 100,000. We had about 12% of female respondees saying they earned at least 100,000 versus 25% of males. So there's going to be a financial resource thing there. And then I struggle for the word. It's not necessarily an education thing, but there seems to be information gaps. We had relatively more females reporting that they haven't bought those females and males who haven't bought a property yet. More females reporting that it was simply because they didn't know where to start. They just didn't know what to do. So now the numbers aren't massive. It was about 16% of females and 6% of males. So it's not sort of off the charts, but there is a gap there. And so it sort of hints at financial resources, maybe sometimes some information gaps that exist. So anything we can do around that, because we know that earlier access to the property market, if that's what people want, or any asset class really, earlier ability to invest will create, it compounds. So it's creating greater opportunities over your lifetime, but also, I guess, to branch into other things as you go. So there's strong sort of benefits there for the individual and society too. So it was an interesting release, as I say, picked up by lots of people. And then the sustainability angle, which is sort of a new question for this year, it was around people who have bought a house. Have you thought about, or have you actually done it? Have you invested in sort of major things like solar panels, for example, or even more minor things like, sort of minor insulation changes or anything like that? And most people had actually done something. I think it was something like 60% had invested in some sort of form of sustainability. That wasn't always a major project like solar panels, but there was a lot of sort of more minor things. For those people who hadn't done it yet, the intent to do so was strongest amongst the younger generations too. So I guess there's a big awareness of this. The Gen Zs are definitely keen to do up their properties if they can. There is a financial hurdle still there sometimes because these things aren't cheap in some cases. But there's an attitude there. There's an intent to do it. So you'd expect to see more and more changes over time and improving our quality of housing. So I think it's a definitely useful report. Go and check it out.
Yeah, absolutely. Yeah, I think, as you say, for the sustainability side, it's definitely an awareness and understanding of how and what you can do. Definitely that split by generation, which I think is a bit more, the younger generations understanding more about what they can do, maybe having confidence to do those little things and do the research to find out what are those things you can do. And maybe they're a little bit more conscious of protecting the environment for their futures. Whereas the older generations maybe, an acknowledgement and know about it, but make it a bit more difficult for them and maybe don't have that same longer term view potentially. Not saying they're all selfish, of course. I don't want to go down that route. But I think it's a really interesting one. And I think importantly as well, and I think I touched on this, importantly, we did have the special guest podcast out last week. Which for anyone that's got auto download set, you should have had that go straight to your podcast player. And if you don't, go and click that little button now so that it does auto download when we do the special guest podcast. But we had Nicole Ferguson, the National Director for Loan Market New Zealand, on last week. And she was great, just talking about all these different little things, right, and some of her experience. She's a strong woman leader, which we like to profile as much as we can, and particularly around International Women's Day. So really good to chat to her. And we spoke about the fact that, it's actually not just about doing the right thing for the environment. It's actually starting to pay off financially as well. And for anyone watching the video right now, you'll see I'm at yet another venue recording the podcast today. I'm up in Auckland today and got a meeting this afternoon with the New Zealand Green Building Council. So, they're getting really higher profile and doing more and more and getting great partnerships out there to ensure that there's not just the benefit of socially doing the right thing, but also financially. It's actually starting to really pay off when you go green, when you build new property, or for many cases, if you can, do those little improvements or retrofit or whatever, whether it's interest-free loans or low interest loans for doing green changes as well, that those are coming through too. So another great, conversation encourager, I would call it, to ensure that we are having this more often. And then, as I said at the start, for anyone that can have an influence on these areas, actually starts to do something with it, whether it is banks or companies or government or policy or whatever it's going to be, just bringing that to the forefront too. So, while the podcast was out last week and the report was also out, and I'll leave a link to that, I'm sure this conversation will only just be starting to ramp up as we get closer to International Women's Day on Sunday anyway. So, we'll leave that one there anyway, Kelvin, but great job taking that one to media and the market again. Good conversations going on. So not too much else on my mind for the property market stuff this week and what's going on this week. I suppose the one thing we should touch on briefly is that the home value index for February will be out this week, given we've just moved past the end of February. I know you have always looked at the weekly index for the main centres, or a couple of the biggest main centres, on our website to see how things might track before we get the actual data coming through sort of in the next day or so. What's that sort of telling us, mate? What's your expectation of what the read's going to be for the index for February when you get that shortly?
Well, I mean, let's call it still broadly flat. I mean, we're talking about a few percentage points here and there, but just, if you sort of squint hard enough at the weekly index, you can maybe see Wellington and Auckland just a wee bit stronger, and Christchurch still edging higher as well. Now, that's obviously not all of our markets, but those three big ones do take up a reasonable share of the overall index. So, maybe just some hints in there. I mean, if I had to have a total guess at the national number, let's call it plus 0.1 on the month, something like that, plus 0.2 maybe. But still pretty flat. We're still going to be down sort of 18% from the peak. It's not exactly sort of booming again. So that's kind of a bit of a gut feel. Would maybe be consistent with I guess what we're anticipating in terms of that slightly stronger economy, that impact of lower interest rates coming through. But definitely won't be a sort of bullish off the charts result. It's more of that broad stability, I'd call it. So we'll see how that comes out. We'll get the figures Tuesday lunchtime, and we'll write that index and turn it around for later in the week. So always intriguing.
As you say, sort of backs up maybe some of that momentum from the lending being done too. Like, you think about the lending that was being done, within that, if there's a bit more competition for properties, then it would stand to reason that, maybe those vendors can work out a little bit of extra price on it if there's two people that are quite keen on their property. And that's what might start to see this market grow sooner rather than later. Although, I still want to acknowledge the fact that, many of the economists have pushed back their expectations, and Reserve Bank we spoke about recently, still see values declining for the next few months. months before seeing some comeback in the second half. I wonder if that's a bit pessimistic, and maybe it just does depend on, not quite the animal spirits taking over, but a little bit of competition that just sees a little bit of upward price pressure on those properties that are listed for sale. And if that balance starts to redress, then we could actually see a little bit more growth come through, I think, in the first half of this year, but still it'll be pretty mild, let's just say that anyway. So as you say, pretty intriguing, and that data will be out publicly available on Thursday, so keep a lookout for that one, and we'll talk in more detail about it next week anyway. Otherwise, mate, how was your weekend? Anything much go on there? Did you catch the Black Caps? I'm not expecting you to have caught it live at 2:30 in the morning or whatever it was, but get up to too much else other than watch a bit of sport. And of course the NRL has started, even though I know your Raiders haven't played yet. But how was your weekend? What else is on your mind?
Yeah, pretty good weekend. I mean, really normal stuff, family stuff, cricket and swimming and mowing the lawns and things like that. So, yep, pretty much home based, and lots of sport to follow, isn't there? I really enjoyed the New Zealand Golf Open yesterday afternoon. I was watching that. It was raining and hailing and windy here, but it looked like a decent day down in Queenstown. So I really enjoyed that, and obviously Kiwi won, so that was really good. And lots of sport in NRL. Yeah, I always really look forward to that. I somehow sort of find myself slipping more towards being a rugby league fan than necessarily a rugby union fan. So don't know what to make of that, but that's the way it seems to be going. And over in Vegas, so it was pretty cool. It seems to be a great spectacle, that. I don't know. Plenty going on in a weekend that actually sounds fairly quiet. So going good. How about you?
Yeah, all good, mate. Yeah, it was a bit of a busy weekend for me, and my daughter's 6th birthday yesterday, so that sort of took up a bit of time. And the only weird part of that was that we weren't planning on going to the Phoenix because she didn't want us to. She wanted to have her birthday day, where she picked all the activities. But about an hour and a half before the game was about to kick off, I got a text saying I'd won the opportunity to be part of the halftime challenge, where 4 of us were out there kicking goals from different parts along the 18-yard box, and trying to win a grand. So I talked to her after that and said, look, I could win some money here, Loretta. Surely I can bribe you with some money if I end up winning. Unfortunately, it didn't quite go as planned, so we went and watched the first half anyway. Went and did the challenge. I scored 4 out of 5. Last one was not ideal, but it was a bit of a tougher shot. And then the guy who went last, who even more unfortunately actually happened to be a Sydney supporter, which is who the Phoenix played against, and he ended up banging in 5 from 5. So he took home the $1,000. I got a consolation pack, and then we headed off to the bowling alley for my daughter's birthday anyway, a little bit of a family afternoon. So look, it turned out all right, but it would have been nice to bag an extra, little $1,000 in the back pocket. So yeah, rough on that one, but not much you can do about that, I suppose. And let's not go again down the result of the Phoenix. I actually thought they played pretty well in that first half that I watched, and conceded pretty bad goal in the second half, and then didn't go much better from there. So yeah, not ideal, but potentially some signs of some improvement there, and certainly given the tightness of the table, not going to write them off for the full season just yet, but a tough run with plenty of away games to come. But that may not be the worst thing away from the pressure of home fans anyway. So yeah, look, we'll keep hope high on the Phoenix, but not exactly expecting too much. But yeah, it was a good little Sunday afternoon anyway. Decent weather down at the stadium, so that's always nice. And yeah, it was a good time. Result of the halftime challenge and the Phoenix aside. Otherwise, went on another mission into the Tarador Ranges on Saturday as well. So an early morning, and up sort of went in at Otaki and up part of the ranges called Mount Mick. So that was a pretty decent mission. We were sort of in the bush for, I don't know, 6.5 hours in the end, close to 1,000 metres ascent in total. So yeah, look, legs were filling it a bit Saturday night, and rewarded myself with a couple of beverages. But no, it was a pretty busy, active, enjoyable weekend, despite, as I say, some of the results. Haven't even gone there for the rugby, but we'll leave that one. And yeah, I think, the fact that you're swinging towards that league, probably not too uncommon, I suppose, given, we've known that the rugby has challenges with supporters and viewership as well. And the league has definitely got some appeal from that perspective. Still hasn't quite grabbed me yet. but I can certainly see the appeal anyway. So, yeah, mate, look, it's all go. And as I said, I'm up in Auckland today and tomorrow. Got a few meetings and functions in the evenings as well. So looking forward to, once again, as I always say, get out there and chat to people about what's going on in their world and see what's happening, particularly in this case around the Urban Development Institutes, not just here in New Zealand, but also over in Australia as well. So I'm meeting with them later on and hear what's going on in that space. You know, it's something we've spoken about a lot from a construction perspective and how it's a surprise that things look like they've sort of come back a bit sooner than we expected. So, yeah, we'll certainly hear what's going on a bit more in that space, and no doubt we'll talk about that in the coming weeks as they come to play, or, you know, data comes out as well, and we sort of can talk in more detail about that one. But, yeah, mate, so, yeah, sort of feels like it's all go, but that'll pretty much do us for the day. Anything else on your mind before we get on out of here?
Just to say, I'm also in Auckland on Thursday at a real estate conference. So yeah, that'll be interesting. Get some of that chat from the front line. I guess what they're seeing in terms of activity, whether there's any sort of clearer evidence of upturn there. So yeah, it'll be a good one.
Yeah, no, it sounds good. I mean, yeah, it does feel like now we've really kicked into gear with the travel and the presentations and client meetings and things. So, yeah, I just think it's a good sign that everyone's, you know, back out there trying to get stuff done, and that means strong engagement with, you know, our business and you and I in particular. So, yeah, really enjoy it. And for anyone listening, look forward to hopefully catching up with many of you on our travels over the next few weeks. So, but that will do us for today. Thank you very much, as per usual, for your thoughts, Kelvin. Always love talking about that lending data, and I know you love getting into the weeds of that. So, thanks very much for all the detail there. Just want to say thanks again. Thanks very much for listening. Please do get in touch with any questions or feedback. Or if you're keen to catch up for a coffee or a beverage, please do let me know while we're out and about too. So that'll do us for today, though. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.